Welcome back. I'm Michael Ball, and this is America's Commercial Real Estate Show. Today we are talking industrial, we're talking logistics, we're talking warehousing and retail. This segment is brought to you by BarnesCreativeStudios.com. Check out that website if you have a development, a project that you want a video on. They do an incredible job. My guest is Barbara Denham. She's an economist with Reis. And Barbara, before the break, we were talking about and the economic impact and some of the things going on in the U.S. and around the world that are impacting the cycle and cap rates and investment sales. So if you can, start us out with cap rates. It seems like on some of these very nice, large industrial, institutional size properties that we've seen some pretty low cap rates in the industrial market.
Yeah, we're seeing some low cap rates across the country, but on average, they have trended a little bit flat over the last 16 months. In fact, what we're seeing is cap rates are a little higher than they were at this point in 2015. So they were flat for, again, about 12 months, and they're just a little bit higher. So they went from about 7.4% from 2015 and 2016 to 7.5%. And it's surprising because it goes against the stronger rent trends. But I think the industrial sector is more of a niche market, and you really need to know the types of the needs in this, in this industry. There's a lot of REITs that buy industrial properties, but for the novice investor, I think it's very hard to get into the industrial sector. That being said, we are seeing an increase in sales volume compared to a year ago. I think people were pretty conservative in 2016, and now things are better. But now I think what this represents is a disparity across the country. There's just some markets. The big markets are doing a lot better than the smaller markets. Markets like San Bernardino, Riverside, Atlanta is doing very well, Houston. The big markets are getting bigger and better, and I think some of the smaller markets are not getting maybe their proportionate share of the business. So I see cap rates did fall in the West, and they were below 7% right now. But it's a very volatile measure. We see a lot of volatility quarter to quarter. But they are lower in the West than they are in, say, the U.S. in general.
Okay. And of course, one of the things that has some impact on cap rates are interest rates. So what do you expect moving forward for mortgage interest rates for commercial real estate properties and potential impact on cap rates?
Well, the interest rate question has been the biggest enigma throughout this recovery. People are wondering why, first of all, why inflation rate has stayed so low. And the Fed funds rate has gone up 3 times in the last 3 quarters, and yet you're not seeing a huge impact in either the 10-year rate or in cap rates. In fact, we did the capital markets briefing earlier this week, and we showed cap rates actually declined over the last 9 months, because I think what's happening is that people are looking at the real estate sector as a safe investment. So more people are buying into the real estate market. Even though the sales volume outside of industrial is lower, they're buying better properties. So when we have a little smaller pool of investment dollars, but they're buying better properties. So you're seeing those kind of better quality buildings trading for a lower cap rate. But that's defying the interest rate trend in general. Going forward, the only thing that will really drive interest rates up is some sense that inflation is going to go up. And with the state of things in Washington, until there's a tax reform plan or an infrastructure plan or even a deregulatory plan, I don't think anyone thinks that inflation is going to go up. And if inflation doesn't go above 2%, the Fed funds rate will probably only go up maybe 1 or 2 more times in the next year and a half. So it's a very interesting economy in that, we're not, even though we have such low unemployment, we're just not seeing the inflation that you would normally see at this stage of the cycle.
Yeah, well, that's interesting because it's hard to tell the the future, right? We all wish we had a crystal ball, but the things that you're telling us here seem to indicate to me and tell me if I'm wrong here that because of the increased demand for commercial real estate in the U.S. and also from abroad for U.S. properties, if interest rates are going to still stay relatively low and have very small increases, that you might see flat cap rates, especially for industrial real estate, for what, a couple more years?
Yeah, you could see flat cap rates. I mean, our model does assume that if interest rates go up, that cap rates will go up marginally, for sure. But at this stage, it's too hard to say, with the interest rates not generating the kind of inflation that it normally should. So yeah, we do see a general low flattening of the cap rates going forward.
Okay, interesting. And what about where we are in the cycle, Barbara? Overall, kind of the cycle, economic cycle. We are here in the U.S., the commercial real estate cycle, and then specifically industrial. Might it have a little bit longer runway than some of the other asset classes?
Well, certainly in the case of industrial, again, because there's a lot of movement in the e-commerce world, especially since now that Amazon's bought Whole Foods, everybody's questioning, well, what's next? What does that mean? Are there going to be a new distribution network for organic food? And how is Amazon going to change the whole logistics for that industry? So it's always, it's a very Amazon-driven industry, but there's still a lot of optimism for the industrial. As far as the broader economy, again, I think there's still momentum in this economy. If you look at, I do a chart showing the cumulative growth rate of real GDP compared to previous expansions. And even though we are already 7 quarters past the duration of the last expansion, we've only grown just ahead of the last expansion, which means, we are not growing at a robust rate. We haven't seen robust growth at all throughout this expansion. And while that has been very frustrating for a lot of investors and a lot of business people, it's actually been very healthy because it hasn't created any of the overinvestment, the overspeculation, or the imbalances that you frequently see when you see a very, very strong rate of growth. And, without the boom, we're not going to have as much of a bust, or we don't even see the downturn going forward. It still looks like we have enough momentum to grow at another 2% this year, probably 2% next year. We're adding about 2 million jobs every year, and again, we still have enough slack in the labor force that we can afford to continue to expand the employment pool and still draw from those who have not been in the labor force for 8 years.
That's such good news, what I hear you saying there. I think I can almost hear just lovely music in the background because I think you're right. I mean, we've had really a slow improvement in the economy, and it's kind of open, the windows have been open longer for companies, for real estate developers and investors to make some moves and to grow in this economy. Well, if you can, Barbara, leave us with a tip either for investor or developer or user related to industrial and logistics today.
Mm-hmm. Well, certainly know your market, but most of the industrial players do. It's a good business to be in, and I would really stick with the businesses where there's the hubs. I think it's all about the transportation and the hubs like Memphis, Atlanta, Houston. But you're seeing it across the country, really. The one thing I should add is every single industrial sector is showing vacancy rates decline and positive rent growth. So some are growing faster than others, but every industry, every market that we track is seeing positive growth. So we're very optimistic about this continuing.
That's excellent news, and the pretty music is still playing. Barbara, thanks for joining us today.
Anytime. Good to talk to you.
All right, and thanks for joining us. Now, stay with us. I'm going to have a developer come in Studio One who does a lot of large development, deals with a lot of tenants around the country, get his take on the market and what we should expect moving forward. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.